Is there any noise on the trading floor this morning?
It's pretty quiet, to be honest, which is normally the case. We've got a sort of effectively a half day's trading here in London, and volumes are very thin. It's been thin all week, in fairness. There are one or two exceptions to that. Obviously, the speculation regarding Smith and Nephew and that takeover, especially when you consider the rumours circulating are for a price at about a 30% premium to yesterday's close, and that's certainly seen a pretty bullish start to trading there, but across the board, still pretty thin.
Yeah, I mean, it seems, despite the gains we saw in the US, seems the European market's a lot more reluctant to push higher, right?
Yeah, I mean, we just need a glance at, say, the Dow and the S&P, both of them setting all-time highs, Dow breaking that 18,000 level, which it had been threatening to do about a month ago, and it's shown some real resilience in the way that it's bounced back, the bounce actually being arguably more aggressive in pace than the fall in the markets there. Europe has been dragged along a little bit more reluctantly. I guess the likes of, say, the FTSE, we've got a bit more weighting when it comes to the oil and gas and commodity stocks anyway, which makes us a little bit more of an issue to join in this enthusiasm, and it looks highly unlikely we're going to actually end the month out positive, but there's still a bit more trading to be done next week, certainly.
Are equities the only place to be right now?
Well, over the course of this year, we keep on repeating ourselves about how bond yields are pretty unattractive, how commodity volatility and demand from Asia has been dwindling. It still remains the primary home for cash at this point in time. The capital gains have been pretty good. The income gains have been even better as corporations have been looking to spend some of that money, not always successfully in the mergers and acquisitions area, so they've been bumping up their dividend payments, so income returns on equities still pretty attractive too.
What do you think is the biggest risk for next year as we start 2015?
Well, we've been talking about interest rate decisions all year. I think the UK seems unlikely we're going to see anything materialise anytime soon. US, though, they've had their economic data, and you touched on it there, the GDP figures, 5%, much better than the 4.3 that we were expected, which was a pretty bullish statement anyway, especially when you consider the UK was talking about 0.7%. It just shows that they've stretched their legs a little bit. The issues that are affecting the Eurozone and Europe and the UK, not really translated across the Atlantic to them. They seem to be keeping a pace, and I guess that there's a fear that there's going to be a divergence between the two economic regions as they move further afield, and the Eurozone pulls us back. And you touched on it there, Greek elections looking ominously like we're going to see them materialise in February, and a general election in Greece. Once again, we're going to have all these austerity questions being brought about there, and I think that'll refocus people's attentions on the other countries in the Eurozone that are struggling.